Don, before I read these the headlines from these minutes, I want everybody to understand these were minutes from after 3 months of lousy inflation data and before a month of somewhat better inflation data. So they may be a little bit outdatedly hawkish, but I will tell you what these headlines are. The Fed discussed keeping rates higher for longer if inflation did not move sustainably towards the Fed's 2% target. They continue to expect, however, that inflation would, in the medium term, edge down towards that target. Recent data at the time suggested the disinflation process would take longer than they had previously expected, and the readings did not increase the confidence for cutting interest rates. Though the funds rate was seen as restrictive overall, many were sort of uncertain about how restrictive the funds rate actually was. They discussed the possibility that the neutral rate may be higher and that higher rates may be less effective at slowing the economy than they had been in the past. They saw the lack of further progress on inflation significantly increasing both goods and service prices across the board. Now, there was a debate. Some saw it as residual seasonality, an issue we've discussed a lot here. Others saw the increases as broad-based. Now, there was also somewhat of a dovish discussion there where they said the easing of the labor market would be seen reducing inflation in the coming months. And they did discuss cutting rates if the labor market weakened unexpectedly. Productivity increases could have been helpful on inflation, and a number saw consumption growth slowing and household finances weakening. But once again, guys, this was after 3 lousy inflation readings before the most recent April one that was somewhat more helpful and some other easing of demand. But you could see sort of how they were processing this, sort of doubting whether or not they were restrictive enough, talking about higher for longer. I still think they're there, but with a little of the, what would you say, just a little bit of the boil coming off right there.
All right. It looks like it appears as though the markets are reading it the same way, Steve. So we'll kind of put that in context as well. Steve, please stay right there. For more on this story, the economy, the market impact, let's now bring in Ken Stern, president of Lido Advisors, and Stephanie Roth, the chief economist over at Wolfe Research. Thank you both for being here. Ken, we'll start with you because you're sitting right in front of me right now.
Yes.
And this whole idea that we are trying to put context around this particular Fed minutes, given the bad inflation prints that we saw going into it, and then the kind of decent one that we got since then.
Sure.
The markets are reacting a little bit more measuredly to this, which is probably the right thing. Do you feel as though this is a situation where the Fed is on the right path?
I do. I mean, the fact is let's take a victory lap for a minute. We had 11 rate hikes. There's wars going on. We're in an election year. We had bank failures within the last 12 months. And here we are at all-time highs. I mean, this is really a resilient climbing the wall of worry story here. So do I think rates are going higher is the probability? No. Do I think rates stay the same or go lower? Yeah, that's the probability. Let's go find opportunity because there's, I think, quite a bit to like in this market today.
Okay, Stephanie, this is also an interesting point as well because this is an environment where there is uncertainty, not just right now, but in the back half of the year as well. All of that plays into the backdrop for how the Fed has to view its future path on rates. Do we feel as though the Fed is doing the right thing by holding pat for the time being?
Yeah, I mean, it makes sense given they're looking for 0.2% month on month in core PCE. That's kind of the threshold that they would make them feel comfortable cutting rates. We haven't been there. That said, the April data were encouraging, so it makes sense for them to watch for the next couple of prints. Our base case is that the next couple of data releases will show core PCE running fairly close to that 0.2%, in which case they can be cutting by September. But they're committed to a 2% inflation target. Something 3% or above is just not acceptable, and they have to maintain their credibility. The good news is we're starting to get some better data from an inflation perspective, and there's starting to be some signs that economic data are softening a bit, such that they can feel comfortable cutting rates, and Waller talked about that yesterday.